Okay, thank you for finding time in your busy day to attend this webinar. I gotta admit, it's been kind of an interesting day, and so I know some nerves might be frazzled. We've got things are moving, and hopefully, I think moving in a more positive way going forward. And I'm going to show you some chart analysis and recent recommendations that we've pushed out to our brokerage clients to kind of try to take advantage of some of the moves that we're seeing today, with hopefully without losing our shirt. That's the idea. So my name is Carley Garner. If you're on social media, you can check me at Twitter, Facebook, Instagram. I post a lot of dog pictures. By the way, I am a futures and options broker. That's my bread and butter. That's what I do for a living. You can reach us at decarleytrading.com if you're interested in that sort of thing. We are a boutique firm, so we're not the biggest, but I do think that we offer the best service. We are experienced, seen a lot of things, learned a lot of hard lessons, and we try to help shorten our clients' learning curve with that information. I am in Las Vegas, Nevada. This is my dog Frankie. If you follow me on social media, you will get to know Frankie very well. I write a monthly column for Stocks and Commodities magazine, and as mentioned, I do contribute to Bloomberg Television, Mad Money, and more recently, the last couple of years, I've been on RFD TV. Some of you may or may not have heard of that. It's a show called Cow Guy Close, hosted by Scott Shellady, and we do that every Wednesday near the close of the grains. And honestly, it's a lot of fun. We talk about corn, wheat, soybeans, and just about everything else you can imagine. This is Scott and I here on the upper left-hand corner. That's Scott. If you've probably seen him, he's been memed a few times. Um, and last plug, I have written multiple books on trading commodities. If you go to Amazon, you're going to see several, probably 7, 8, 9. Don't worry about those. Worry about these. These are the newest, the most current, let's say. And I would also like to say the best. And before we get started, I just want to point out that there is substantial risk of loss in trading futures and options. Trading and speculating is far different than investing, two different practices. And trading and speculating is not for everybody. I would actually say that it's probably not for most people. I am a futures and options on futures broker. So we offer both futures and options, but I tend to lean towards option trading for most traders. Now, again, it's a preference thing. Some people prefer futures because they're simple, the math is simple. I think options are definitely worth consideration and worth looking into simply because they give you more room for error. They're flexible. You can use various option types, strike prices, and expirations to pinpoint speculations. You can pinpoint where your risk and reward is, how much you're risking, how much you could make. You can pinpoint the timing. The exchange is constantly adding fresh expiration dates. For example, a lot of commodity markets now have Monday, Wednesday, Friday option expirations. In fact, a lot of them actually have options expiring every day of the week. Some of them even have morning expirations and evening expirations. So you can get really specific with your speculation using options. Options are generally less volatile than trading futures outright. Not always. It depends on how you approach the market and what strategy you're using. Generally, they come with lower margin and risk, usually a lower cash outlay, or in some cases, the market actually pays you to put on a trade. And when you're constructing option spreads, you can actually benefit from time value erosion if you're an option seller or you're trading spreads. The time value erosion that works against option buyers can work for you. Now, if you're in a situation where time value is working for you, it does mean you're using a strategy that probably, well, most likely has unlimited risk. The thing about options are they are building blocks, and they can be put together for any risk reward profile. This is a really, by the way, I'm just going through like a really quick crash course on why I think options are worth considering, but then we're going to go through some examples for educational purposes of trades that might make sense in the current environment. They're option spreads, so you'll get a better understanding of what I'm talking about regarding using building blocks to create a particular risk reward strategy. Trading is 99% mental. I know a lot of people spend a lot of money on trading signals and mentors and all of these educational products, and that's fine, but the honest truth is It's a mental game, just like athletics or other things. If you don't have your mind right, you're already behind the curve. You must be in a stable mental environment and mental state to make proper decisions. Otherwise, you're going to succumb to human nature, and that's never a good thing. Humans like to seek immediate gratification rather than long-term gratification, and that works against us. We also tend to focus on reward, not risk, and that's not good either. So very quickly, options are building blocks. You can combine long calls, long puts, short puts in many different ways. If you're constructing an option spread, there's usually antagonistic legs, meaning some of the legs work to make money and some of the legs work to hedge the others. We're going to give you some examples on those. One last tip, strive to be cheap. Options are priced to lose. So it makes sense to be cheap. You don't want to spend a lot of money on an option that's probably going to expire worthless or probably going to lose money over time. I've had a unique perspective on option trading because I am a broker. I see various strategies and approaches and mindsets. And I can honestly say that nothing in life is free, especially not a free option trade. So I'm going to show you some examples on how to use the market's money to speculate in the commodity markets. And I'm going to use the words like free trade or credit, meaning the market's paying us to trade. But that doesn't mean there's no risk. There's a big difference. Nothing in life is free. Because most options expire worthless, you should behave accordingly. It's generally better to be a net option seller as opposed to being a net option buyer. So you want to try to collect money on short options to pay for long options. And you can do that in a limited risk manner. Today, I'm going to show you how to do it in a more aggressive manner. So let's go take a look at some strategy examples here. So the Carley Perspective is a newsletter that we send to our brokerage clients, and it offers trading ideas. And I say ideas because not everybody's built different. Not everybody wants to trade options. Not everybody wants to do things in the exact same way. And that's okay, because as I mentioned before, trading is a mental game. So the key is to make sure you're doing something that you are comfortable with. If you're comfortable, you're going to make better decisions. If you're uncomfortable, you're probably going to be prone to panic. Scared money never wins. Let me put it that way. So this is actually a trade that we suggested our clients consider this morning. Again, I'm not telling you to participate in this trade. I'm just doing this for educational purposes. So this will give you an idea of how you can use the market's money to pay for a speculation. This morning we saw the bottom fall out in gold. The interesting thing about this is the gold market usually has this kind of a washout in the late summer, early fall, just like we're seeing. I think I want to say 3 or 4 days, gold's dropped over $100. So it's been a very quick drop, and some people might be a little bit shocked by that. Reality is, for some weird reason, it almost always happens. It usually happens in August. We've been kind of waiting for this. In fact, I was lucky enough to visit the Mad Money studio in July, I believe it was. We talked about this. We talked about being on the lookout for a washout in gold at some point in late summer, early fall, to try to get in at prices that are attractive on a long-term basis. And our initial figure was 1870 on the December contract. And just today, we got down to about that level. To be honest, I thought it would happen in August. It took an extra month to happen, but you just never know. Markets are unpredictable. This is an art. It's not a science. If we're making educated guesses, and sometimes we're a little early, sometimes we're a little late, sometimes we're wrong. In this particular case, we finally got the sell-off that we'd been hoping for. This morning, we advised clients to consider buying January 2000 calls. I'm going to point out that the January options trade against the February futures. The February futures are higher than December, and that's because of interest rate differential between the expiration dates. So it's a little bit tricky, but the February contract was trading at about 1910, 1911. The December was trading at the time about 1890, so it's a little bit lower. But again, we're in the price range that we think gold might be a better buy than a sell. And instead of spending $1,400 on a $2,000 call option, which again, we just said options are priced to lose, we purchased that option and then used a short 1850 put to pay for it plus some. In other words, we sold the we recommended to sell the 1850 put and use the proceeds to buy the $2,000 call. Initially, we were getting about $400 credit, but some of our clients were lucky enough. There was a bit of a washout in gold today. Some of our clients were lucky enough to get much bigger credits. I think somebody maybe got somewhere around $1,000 or maybe a little more on the credit. So the market paid him roughly $1,000 to buy that 2000 call. The trade-off for the opportunity cost is now that trader is responsible for losses below 1850. So if he holds the option to expiration below 1850, he has unlimited risk. It's almost like being long a futures contract from 1850. If you were lucky enough to collect $10 or $1,000 to put this trade on, you have a buffer to 1840. So the only way to lose money on this trade if you hold the expiration, and that's a big if, most traders don't hold the expiration, but I'm just trying to give you an idea of how the math would work. If you held the expiration, you would only lose money if the market was below 1840. Anywhere above 1840, you make something. If we're right about gold finding some sort of a low and rallying sharply later in the year, then we stand to make quite a bit of money on the $2,000 call. So we have unlimited profit potential above 2,000. So in a best case scenario, maybe we run up and test 2,100 or higher. And in a situation like that, we could easily come out. I shouldn't use the word easily, that was the wrong word. If we were lucky enough for gold to go up to 2,100 or a little higher, that would be roughly a $10,000 winner, somewhere in there. I'm not saying that's going to happen, but that would be what we would consider the best case scenario. In all reality, a trade like this, we would be very, very happy if it went our way initially and we could pull out with a $2,000, $3,000, $4,000 profit. I would take it and run. But I'm just trying to let you understand how the math works. You can see why there's multiple, like we've done some weekly and monthly studies that suggest that 1870 to 1900 is probably a place for the bulls to consider being bullish and actually doing something about it. But you can see on this daily chart also that there's some compelling evidence that maybe that's not a horrible idea to buy there. Of course, that doesn't guarantee anything. Markets can do whatever they want whenever they want, and you have to be prepared for that. But this trade can be wrong by roughly $60 to $70 in gold and still not lose money. And so that's the kind of strategy that I am more comfortable with as opposed to just going long a futures contract and hoping for the best. So this is typical of how a newsletter that we put out would be structured. It gives an explanation of why we think this might be a good idea. Let's look at the stats of this particular trade. So we're buying the 2000 call, we're selling an 1850 put. Again, I said we were collecting 200 to 300 in the beginning. Some clients got much more than that because of the volatility today. The margin on a trade like this is 6,200. The exchange charges margin because there's unlimited risk below 1850. If the price of gold drops close to 1850 or below, the margin on this trade is going to go up. So option margin is dynamic. It's not static. It doesn't stick forever. It's not always going to be 6,200. It will go up and down with the market. If gold rallies, the margin will go down. If gold drops, the margin will go up. But that gives you a good idea of the starting point. And these options have 89 days to expiration. So we have almost 90 days, almost 3 months for gold to do something on the upside. And as long as it doesn't completely melt down below 1850, 1840, we come out a little ahead. This is a trade that we put out a couple of days ago. So this is in the E-mini S&P, and a lot of people thought we had lost our marbles trying to go long the S&P in this type of an environment. That's what our chart is telling us is makes sense. Also, I should point out that the seasonal bottom in the S&P is right around now. It actually was yesterday or the day before. I mean, seasonals are patterns that markets generally adhere to. It's not perfect. Sometimes they're late, sometimes they're early. Some years they don't work at all. But more often than not, the stock market has a rough September, and then in late September, early October, it usually bottoms out and moves higher. This is particularly true in pre-election years. So this year, statistically, we have a pretty good shot at that occurring. And you can see the circle I have on the chart here. That's where the 200-day moving average comes in. We did touch that level and we did hold. And I believe that we have seen the bottom. Again, it's a speculation. Maybe we have, maybe we haven't, but we are betting that we have. However, we put together a trading idea for our clients that gives people plenty of room for error should we be wrong. If we're wrong, there's really not a whole lot of support until we get down into the, I mean, you could argue 4,200. I'm not going to argue that that's not supportive. I think it probably is. But the reality is, if this trend line breaks and that trend line comes in and that 200-day moving average comes in around 4,270 on our charts, if that breaks, there's really not much stopping it to 4,000. So the recommended trade that we put out was to put on a vertical call spread, buy a 4,400 call, sell a 4,550 call to help pay for it, and then also sell a 4,000 put. We chose 4,000 because we believe if the bottom does fall out, that's probably going to be where the selling dries up. Hopefully we don't see that, because if that does happen, this trade would be under quite a bit of duress. But if support around 4270-ish holds, as we believe it will, this trade should work out nicely. And we collected enough premium on the short put and the short call to cover the cost of the long call. So a trade like this is basically saying, I want to be long a call option in the S&P, but I don't want to pay full price for it. It would cost you $84, and S&P points, each point is worth $50. So we're talking like $4,200 to buy a December 4,400 call. I'm not willing to spend $4,400 on anything, let alone a call option that might expire worthless or probably erodes over time. So instead of spending $4,000 on that, we can collect 1,500 on the call and about 2,000 or so on the put, about 2,300. So the net cost is about 7 or 8 points. I didn't look at it today. This trade's probably profitable a little bit by now, but basically this trade, if you were doing it a couple days ago, would have cost just 7 points or so. That's $350 plus transaction costs. So it does cost a little out of pocket, but it puts you in a situation where you can make 150 points on the long call spread, and your risk isn't until we get below 4,000. So things would have to get pretty ugly for you to get into trouble on that 4,000 put. It's not impossible, but it could happen. And let me show you what the stats would look like on something like this. So the margin is about 7,300, and when I say the margin is 7,300, I'm not saying that you should try to squeeze this into an $8,000 account. If you want to do a trade like this, you should probably put it in an account that has 20, 30, 40, 50 grand, because the exchange margin is the figure that they think is probably the worst case one-day scenario. So if that gives you an idea, if you're trying to squeeze trades into smaller accounts and using all of your available margin, you're most likely going to encounter a situation where you're forced out of the trade prematurely. And that's really, really expensive and really hard to overcome in the long run. So make sure that if the margin's 7 or 8 grand, you're putting in an account much bigger than that. If you can't afford 7 or 8 grand, or you're not willing to put that much up against this trade, there are micro S&P options that are 1/10 the size. So the margin would be 730, not 7,300. And the risk and reward would also be 1/10. So in this situation, we have unlimited risk below 4,000. The maximum profit's about 7 grand. But if you were doing these with micros, the maximum profit would only be 700, not 7 grand. So it's a much different ballgame, but it's a lot more comfortable, especially for beginning traders. It's a really good way to get your foot in the door. These options expire on December 14th. They have 79 days to expiration. So again, this is a strategy that allows us to play the upside in the S&P without having immediate risk. Our risk is all the way down at 4,000 if we hold the expiration. It would be hard to imagine the S&P under 4,000 at expiration. It's not impossible by any means, but according to my analysis, it's probably not probable. Okay, I think we have time for one more. So I showed you 2 trades that haven't materialized yet. They are in the works. The jury's still out whether or not they're going to work. I'm going to show you a trade that didn't go as expected, and we're underwater on it, but that's part of trading, right? You win some, you lose some. Hopefully you win more than you lose, but this is a really tough game. We're trying to beat the markets. If it were easy, everybody would do it. I do believe that this trade will eventually be fine, but it's taken some heat. There's a lot of selling pressure in the treasury market. In my opinion, it has nothing to do with fundamentals. We're seeing people sell treasuries despite the fact that the economy is not accelerating. It's done better than expected, but it's not accelerating. Seasonals are supportive. Also, inflation is far tamer today than it was a year ago when we were at similar yields. So it's really hard to justify selling treasuries here. I think people are selling because they have to, not because they want to. It might be margin calls. It might be to hedge their portfolio in the cash market. It could be a lot of things. But there are more people or more contracts short the 10-year note futures now than we've ever seen in the history of 10-year note futures. So everybody's short treasuries. That tells me we're capitulating. The problem with capitulating is you don't know when the madness, there's no limit to the madness. Maybe we bottomed out today, maybe it's next week, and we don't know from what price, and it's going to be really hairy in between. It's been my experience that capitulation is always temporary, eventually. In this particular strategy, we were suggesting traders buy a 119 call in the 30-year bond future, sell a 122 call, and then sell a 114 put to pay for it. This was a trade that we paid about 20 ticks to get into. So we collected enough money on the two short options to mostly pay for our long options. Instead of paying $2,400 for this option, we really only paid a few $100 for it. The downside is we have unlimited risk below 114. According to our monthly and weekly charts, if treasuries were to capitulate, which they did, so we weren't shocked that it happened. We knew that was a possibility. Our charts were suggesting capitulation would bring us to 114. As it turns out, yesterday the overnight low is closer to 113. So we did surpass that a little bit, but it hasn't changed my overall thought process that we are capitulating and putting in some sort of a bottom. So what we're doing with these spreads right now, that 114 that we sold for 50 ticks, which is a little less than 1,000, is worth a little more than double that. So we're taking some heat on that. The good news is this short call that we sold for $1,000 is only worth, I think, about $300, $250. So we bought that back to get it out of the way and open up the upside. Now somebody that is trading this strategy would be left with a long call option and a short put option. We still have unlimited risk below 114, but if time runs by and we don't really have to rally, if we just simply don't go down any further and we hold all the way to expiration, this trade actually comes out probably a small loser. On paper right now, it's showing to be a pretty decent sized loser, but that's how these option spreads sometimes work. It takes time for the volatility and the time value to run out. Nonetheless, our timing was less than ideal on this. I still think we've got a shot at it. The first thing we'll do if treasuries try to rally out of the hole is try to get that 114 put out of there, buy it back, hopefully at a profit, because that's where most of the risk is. The thing about treasuries is if and when they do turn around, they turn around very, very sharply. So it tends to be an all or nothing type of deal. We looked pretty terrible today and yesterday, but that doesn't mean we can't be heading the other way by next week. And I think, believe it or not, I think we might. If the spread was held intact, the maximum profit would be 2,700 because we have since recommended to buy back the short call. It's theoretically unlimited on the upside, but we're way underwater. It would take a big move for that to come, for unlimited profit potential to come into play. We'd be happy with a scratch, I'd say. Risk is unlimited below 114, so we're trading right around there now, so it's a little bit dicey. These options still have about 2 months to expiration, so we've got some time. We just need, hopefully, the market to help us out a little bit. Get creative. Option spreads can be broken, rearranged. Just because you put 3 legs on when you got in doesn't mean you have to get out of all 3 legs at the same time. It's the same as entering. You don't have to put the entire spread on all at once, although I generally advise that you do. Think outside the box. You have to be in it to win it. Keep a foot in the door, but make sure you have your risk in areas that are unlikely to be seen. Again, nothing is impossible. We've seen impossible markets all year. But if you're creative, I think you can keep your risk at tolerable levels. If you're interested in learning more about some of the strategies that we talked about today, you can visit tradingcommodityoptions.com. There you'll find some information on my book that not only covers these strategies, but many others, and it goes through various examples of the good, the bad, and the ugly. And I appreciate everybody coming out. I hope you learned something, and if you have any interest in brokerage services or learning more about trading commodity options or futures, visit decarleytrading.com.